Hello, everybody. My name is Lush Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending February 3rd, 2023. Looking at the market indexes for the week, the TSX, Nasdaq, S&P 500, and Russell 2000 were all up on a positive week. Dow Jones was down by a tiny bit. Gold and oil, however, were both down for the second week in a row. Looking at Canada, Canada's apartment vacancy rate is 1.9%. That's the lowest it's been in 2 decades, thanks in part to rising mortgage rates that have driven would-be buyers to rent. This keeps rents up, but rent prices seem to be wobbling. Currently, Vancouver, Toronto, and Victoria, BC have the highest rents in the land. The high amount of immigrants is contributing to the high rents. 2/3 of Canadians have 5-year fixed rate mortgages. For about the past decade, with interest rates hovering around 1%, this wasn't much of a problem. These days, most banks are charging around 5%. That means if you borrowed $500,000 to buy a home 5 years ago, your mortgage payment could go up by $1,200 a month if you locked into another 5-year fixed term right now. This is worrying Canadians. The remainder, 30 to 40% of Canadians, have a variable rate mortgage and so have been paying more for a year already. Taking a look at the Canadian Central Bank's monetary policy, it is expecting a slowing demand from due to the increasing interest rates that they've been building as a part of their monetary policy, helping the economy rebalance. Higher interest rates are weighing on household spending, particularly on housing and big ticket items. As the effects of higher interest rates continue to spread through the economy, spending on consumer services and business investment is also expected to slow further. As well, weaker foreign demand will weigh on exports. Growth is expected to stall through the middle of 2023, allowing supply to catch up with demand. On an annual average basis, growth of gross domestic product (GDP) is projected to slow to about 1% in 2023, but stay out of a recession. With the declines in energy prices, improved global supply chains, and a slowdown in demand, Consumer Price Index (CPI) inflation is expected to decline significantly this year. CPI inflation is projected to fall to around 3% in the middle of 2023 and reach the 2% target in 2024. With inflation back to target, sustainable growth in Canadian economy will resume, picking up to about 2% in 2024. This has been the monetary policy report that the Canadian Central Bank puts out every quarter, and I would heartily recommend at least thumbing through it. Turning to the US, the Federal Reserve's battle with inflation continued Wednesday with an interest rate hike of 0.25% from 4.5% to 4.75%, and a possible indication that more increases are likely on the horizon, depending on the data. The announcement was expected and smaller than the hikes investors have gotten used to recently. Quote, the inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases, end quote, Powell said during a news conference. Quote, and while recent developments are encouraging, we will need to substantially more evidence to be confident that inflation is on a sustained downward path, end quote. While he said that it would be premature for the Fed to claim a victory over inflation, Powell said that, quote, disinflationary process has started, end quote. He also said the economy would be in for a soft landing after all. Quote, my base case is that there will be positive growth this year, end quote. The markets took off following the Wednesday press conference. feeling confident that peak inflation is behind us and that interest rate hikes will cease soon. Now, there's those who think that central banks will be cutting rates in the latter half of the year. I expect the US Fed, especially, to be very slow to pull back its rate hikes, and that the full effect of the hikes is yet to be felt in the economy. The confidence among company CEOs is not very high, and there are more risks to the downside. Rates have been in emergency lows for a decade, and there's no reason we need to go back there just because we had been there. It will all depend on the inflation and economic numbers. My expectation is that the US federal interest rate will peak at the 5% to 5.25% rate. Note that compensation in the services sector and the job market remains very strong. If the job market stays strong and services inflation persists or re-accelerates, the US Fed could resume interest rates hikes after a widely expected pause this year. The Fed needs to signal that its policy is still restrictive, even as it slows the pace of rate hikes, quote, jawboning the inflation down. But as long as people have money to spend by having jobs, they will keep the demand and therefore inflation high. I'm sure everyone knows that we are in the middle of the earnings season for quarter four, and so far the season has been better than expected, although the expectations have been brought down a lot, both by companies and by experts. The numbers are worse than previous years and quarters, but better than expectations. The US jobs report on Friday came in better than expected, a lot better, indicating a strong economy and further worries about inflation. The US added 517,000 jobs in January, causing the lowest unemployment rate since 1969. The expected jobs to be added was 197,000, so beating expectations handily. The markets reacted negatively also because the wage inflation was 4.4% year over year, higher than the 4.3% that was expected. This past week, General Motors easily topped Wall Street expectations for its quarterly results. Earnings per share came in at $2.12 versus $1.69 projected by analysts. Revenue also came in higher than estimated at $43.11 billion. The earnings report is the latest indication that the auto sector is starting to normalize again after dealing with high demand amid a low interest rate environment and supply chain snarls triggered by COVID pandemic. Still, it wasn't all great news for GM as it reported tightening margins, an issue the industry as a whole is going to need to contend with as price wars heat up. Oil behemoth Shell on Thursday reported its biggest annual profit ever, $39.9 billion in 2022. That's more than double its earnings for 2021, and it's well ahead of its previous record of $28.4 billion in 2008. Sky-high energy prices driven by supply concerns stemming from Russia's war in the Ukraine boosted the results. Shell is following similarly huge earnings reports from rivals ExxonMobil and Chevron. All told, Big Oil is expected to break annual profit records in total. And the latest US JOLTS data indicates an increase in unfilled job openings from 10.4 million to 11.0 million, and a broadly unchanged quits rate, meaning people leaving their jobs. The main takeaway, yet another indication of continued robustness of the US labor market. For some bits and pieces, there is some good global economic news that greeted the US markets on Tuesday morning. Overnight, the International Monetary Fund boosted its growth forecast for the year to 2.9% from a previous outlook of 2.7%. Quote, economic growth proved surprisingly resilient in the third quarter of last year, with strong labor markets, robust household consumption, and business investment, and better than expected adaptation to the energy crisis in Europe, end quote, said IMF Research Director Pierre-Olivier Gourishat. Indeed, the Eurozone helped ease fears of a global recession Tuesday morning by posting surprise growth in the fourth quarter. Despite the good news, though, inflation and Russia's war in Ukraine still pose risks to the world's economy. And finally, looking at next week, we have the ongoing reports. So, companies reporting next week. On Monday, we have Activision Blizzard, Finning International for construction information. On Tuesday, we have Intact Financial, which is a Canadian insurer. On Wednesday, we have the parent company for Brookfield, Sun Life, Great-West Life. On Thursday, we have Toyota, TELUS, Cameco, IGM Financial, Bombardier, and Canopy Growth, Canada's health industry. And finally, on Friday, we have Enbridge, Fortis, and Magna. The economic events next week. On Wednesday, we have U.S. oil inventories, and on Thursday, we have U.S. natural gas inventories and U.S. jobless claims. That concludes my thoughts for the week. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.